Welcome to the HMO Property Show, by investors for investors. Brought to you by the HMO Property Co, Australia's leaders in impact investing. Investments made with the intention to generate a measurable, beneficial social or environmental impact alongside a positive financial return. Catch us weekly as we discuss all things cash flow positive property investing.
Welcome back to the HMO Property Show. Today we're on episode 6 and we're here with my good friend Julie Taylor from Living Off Property.
Hi Neil, it's great to be here. Thanks for inviting me along.
It's an absolute pleasure.
My favourite thing to talk about property.
Now, this is the thing though, this is a short podcast and me and you could literally talk about property for days, I think. As
we have already done.
Yes. So the challenge is going to be keeping this short, but also giving people the value that they need from this as well, because you are a very good investor.
Thank you.
You have a very structured approach to your investments.
Absolutely.
And you live off property.
Yep.
And at the HMO Property Co, that's what we're all about. We're all about helping people create financial freedom and a portfolio that creates enough cash flow for them to live life on their terms. And I thought, I'm going to get Julie Taylor in and talk to her about how she structures hers specifically, because it's really good and I really like it.
Yep.
So, Julie, tell us about the actual way you structure your portfolio, because it's got 3 components, hasn't it?
Yes. So, as you've mentioned, I have a portfolio approach to property investing, and one of the reasons for that is that I would have been in my early 40s when my marriage unexpectedly fell apart. And I needed to support my son and myself, and I decided that I wouldn't go back to work on a full-time basis. I would just see if I could. I took 2 years out to see if I could work out how to support myself and my son for my property investing. And I'd been doing property investing for like 20 or 30 years by that stage. So I sat down and I thought about, okay, how do I make all this work? How do I feed my son and myself and put a roof over our head and actually do that from my property portfolio, but still thinking about the future? Because as you know, there's 2 major categories with property investing. You need to get some capital growth, because capital growth, to me, that's what really creates wealth. And that really looks after your future. But as you've mentioned before on some of your earlier podcasts, cash is king.
Yes.
So you need to have cash flow, and cash flow covers your living expenses. So if you want to support yourself from your property investing, you've got to have cash flow. So then, specifically answering your question, I then have a management consulting background.
Yep.
And I brought that understanding of risk and how you manage risk to structuring my portfolio investing. And I basically said, hey, you have low risk investing, you have medium risk investing, and you have high risk investing. And I then went through and looked at the different types of investing that I'd already done, and I classified them against those medium, low, and high risk investing. So to give an example, I tend to say residential property is very much inside your low risk investing.
Low yields, plenty of tenants out there, so that you can always access tenancy really easy.
Which is why it's low risk. And also I know, people like Harry Dent come out to Australia and they say, the Australian property market's going to collapse and you're going to end up with a 40 or 50% market crash. Well, I've been investing since the 1980s and I've never seen anything like the property market go down that much. There is a need. Everyone in Australia needs a home. So to me, homes are very low risk. It's the chances of the market going down significantly are really pretty low. So I classify it as low risk. But you're correct, the yields are very low as well. And typically, certainly when I first created this approach, at that point I was consistently getting about 3 to 4% net yields. From a pretty stock standard residential home. And I tended to build them, so newer homes generally get a higher yield than older homes. So I built them and I get 3 to 4% net yield.
And when you're getting that net yield, is it unencumbered or is that leveraged?
So when I use the term net yield, I literally mean your gross income less the operating expenses for a given property. And I exclude debt. Because to me, debt is very important and leveraging up is really important. It's how you create wealth. but you need to be able to compare one property against another, and then you can choose where you have your debt and where you place your equity. So when I quote net yields, I'm quoting exclusive of interest.
Yep. Excellent.
Yep. So it's gross income less property direct expenses.
So property management, insurance, council rates, water rates.
Yeah.
That's kind of where we're sitting there.
Land tax.
Land tax, yeah.
Yep, that sort of thing.
Yep.
Correct.
Brilliant. And you've got property in Queensland as well, so the land tax component there is different to Western Australia as well. And it could be changing from what I hear.
Yes.
Yeah.
Let's not go into that one, because that could be a disaster. But anyway, and hopefully they'll see some light and not make some pretty stupid changes that are coming down the pipeline.
So we've got the standard resi in the low risk.
Yep.
What's sitting in the medium risk?
So the medium risk for me is primarily commercial property. The reason why commercial property is more medium risk is that it still very much reacts to business confidence. And if your commercial property goes vacant, it is not uncommon to have the property vacant for a couple of years.
Yeah.
So, as you go through a downturn, certainly we've seen some shocking results on commercial property in Perth, for example.
Yep.
Lots of vacancies for multiple years. As you go through that downturn, and the property is vacant, the value of the commercial property is really deemed from its actual rental income, net rental income.
Yep.
So if you've got no net rental income, then the value has decreased substantially. And that's why it goes into that medium risk.
Yep.
Yep. And
I was going to say, and like if you do lose that tenant and your property is vacant for 12 months, you essentially have to pay the holding costs on that with no income.
Yep.
So whilst it produces a high yield in a resi property, it's still classed as riskier than a standard resi property.
Yep,
Yeah.
absolutely.
Yeah,
So I've managed that risk with commercial property by having multiple tenants.
Yeah, HMO your commercial.
Yep, so you can HMO your commercial property.
Yeah.
So again, if you lose a tenant, and I've had some tenancy spaces in my building have been vacant for 18 months to 2 years.
Wow.
But, it might be half a floor over a four-floor building.
Right.
So, it doesn't really matter too much. It's just pure profit that's gone for a while.
So it reduces the risk a little bit because you've got multiple tenancies in that one commercial space.
So I've managed the risk effectively.
Yeah,
yes.
yeah, I like it. Then we've got the high risk.
Yep. So high risk investing is really where you're doing active investing. It's where you're doing, say, development projects or you're doing renovation projects. It's really where you are manufacturing capital growth or wealth, which is what I think is so important for the future.
We love a manufactured growth strategy, don't we?
Yeah, absolutely. But for me, you've got to get your passive income out of your low and the medium risk investing. That's where I want my daily living expenses covered from. And then I use my higher risk projects where I'm doing my development projects, which is what I primarily do. I'm not a big fan of reno just because I find that too hard work. So I'd rather do a development. And so if you do a development, you might not get a result for 2 to even 5 years, depending on the size of your development. So you can't rely on the money coming in from that development or the profits coming in from that development to actually support your day-to-day living expenses. That's in my experience. I know people that do, but then you just got to make sure you've got a pipeline to actually make that work.
Yeah, it is just a very lumpy cash flow game, isn't it, development, like you say. It can be... flip something on for 6 months and flick something on after 6 months and make a short profit, or hold it long term, develop it, and but it's a long term in between meals, isn't it? And this is where that passive income works.
Absolutely. So if you've got some basic passive income that at least covers your day-to-day expenses, then your luxuries, like your purchase of your next car or your overseas holiday, that can actually come out of your active investing, which is the higher risk investing when the money's there. Yeah.
So how do people know how much they need to create cash flow wise to reach financial freedom, as we call it?
Yep. I think financial freedom has a different definition for everyone. I think the ultimate in financial freedom is when you don't need to have some sort of active work or day job. And then it's really up to you to work out what level of passive income you actually need. But I think there's a huge spectrum of financial, it's not complete freedom, but a financial independence. So you can choose to work and maybe cut your hours down because you've got some passive income coming through. So it's giving you choices as you're gradually building up to what that ultimate level, actually, what you want it to be.
Yeah. And like you say, the equity component's still there in the background going up, but essentially you can't really access that and spend it, because once you spend that equity, unless you're investing it in another investment, it's essentially gone, hasn't it? And
yes.
Any yield or cash flow that equity was producing also drops down too. So we want to hold that portfolio long term, create cash flow and equity, and leverage into other deals that also create cash flow as well.
Even from your whole portfolio, you will be getting some levels of capital growth. So, for example, on my commercial property, I've had great capital growth over 10 years on it, probably averages out 4 to 5% per annum on that property. But I tap into some of that capital growth and some of that money to actually do upgrades to the building.
Right.
So, yes, you can use some of the growth and access some of that growth if you need the funds, but I wouldn't rely on that.
Okay.
So, to me, growth is a bonus.
Yep. It is a bonus, and like we don't particularly talk about it too much at the HMO Property Co, because we are focused on replacing our incomes with cash flow, and the equity growth is a cherry on top.
Yep.
Because I heard someone say you cannot eat equity, which so true, isn't it? You need that equity there to produce the cash flow.
Yep.
So, Julie, if I had, for instance, $1 million right now, how would you structure that in a portfolio approach?
So it's a great question. So typically I would break the $1 million into, if you like, thirds across each of those categories.
Yep.
So if you've got $1 million, if you put roughly, say, 350,000 into your residential segment of your investing, that would earn you approximately sort of 3.5%, which would be somewhere around about $12,000 that you could get out of your net income from that property in a year.
Yep.
And then I'd put another 350,000 roughly into my medium risk investing, typically a commercial property.
Yep.
Typically commercial properties, my experience has been I can generally get about 8% net yield on that.
Brilliant.
So 8% net yield on, say, 350,000 is somewhere around about 26,000, I think, something like that. So you're getting a much higher yield. So now I've created a passive income of around 40,000, something like that as passive income, which would actually cover most people's day-to-day needs for supporting themselves. And then I'd say, okay, the last 300,000, just short of a third, I would put that into projects.
Yep.
And when I do my own projects, I'm generally targeting 40 to 50% per annum return on my capital that I'm using. Might take 2 or 3 years to get that money back, as we've talked before.
Yep.
But you can also invest in other people's projects. So you don't have to be doing your own projects. And I've found, and certainly I've used I have my own self-managed super fund, and because I'm not allowed to invest in my own projects in my self-managed super fund, I've done a lot of investing in other people's projects. And so I now know I can go into restricting my risk to some extent for my self-managed super fund, and I can get roughly 20% return on my capital per annum by investing in other people's projects.
Brilliant.
So if I'm putting 300,000 in, I've just made roughly 60,000 per annum. So now my income is getting up pretty close to 100,000.
Yep. And that is how we live off property.
Yeah, that's how you do it. And you do it with $1 million. People often talk about, that $1 million, they don't have that $1 million, and it's a bit of a challenge to get there. But honestly, once you can get to about 100,000, you can still quite quickly start to build up the capital and get yourself to the $1 million, or 500,000. If you've got 500,000, you can earn sort of 40 to 50,000 quite comfortably per annum in total.
Correct. And off the back of that, I will say that you do need to make your money work for you to get to these $500,000, $1 million, because you cannot save your way to wealth. We need to invest in assets that go up in value but also produce cash flow, and then we compound that growth into more deals, which is exactly what Julie does, exactly what I do. it's a lot of what my network does, and
Yes.
surrounded by a lot of people in this space. What sort of opportunities do you see in the market right now, Julie? And we'll talk about like an Australian-wide sort
Yep.
of view rather than just niching down into Perth. But is there an area that you're seeing, because you've done a lot of developments yourself as well?
Yes.
You've done apartments,
Yep.
you've done a lot of like residential developments too.
Yep.
Is there a niche in the market that you see growing at the minute, or something that you're trying to get into?
Yep. So to me, my preference is to do developments. I actually have, first time for years, I have no actual development on the go at the moment. I wrapped up my last one last year, and we haven't kicked off any since then. And one of the reasons for that is the risk that's going around with builders. For me, if I'm doing a development, my most critical factor is how long will it take to do the development. Because if you extend it for another year to 2 years on the time frame, it can really start to eat away the profits. So you've got to have a great relationship with your builder. You've got to know and trust your builder, and you've got to be confident that they can deliver in the time frame. The builder that I've used a lot in Brisbane, unfortunately, he's just retired. He decided halfway through our last project that he would see that project out, and then he would, he was quite young, he's still only in his 40s.
And he's retired.
But he's decided to retire.
Is he living off property?
Yeah.
Yeah, nice, good
Yep.
lad.
So the advice that I had, I don't know, when I was probably in my 30s from developers was, yes, you can run around doing lots and lots of different developments, but really if they'd have just held a couple of them from their early days, they would have been just as wealthy without all the work.
Yes.
So it's getting that balance again, which is what we keep talking about. So opportunities in the market right now, I think there are some real challenges from what I've seen, but I've still got some projects going where we're doing land subdivisions.
Yeah.
So I've got one going on the outskirts of Melbourne, about 50k out of Melbourne, where we're doing land subdivisions to with an existing home on it, but we're dividing it up into 1,500 square metre lots. And
Awesome.
yeah, it's looking good so far.
So you're just the capital investor in that one? Kind of bit of both, a little bit of...
I'm never just purely a capital investor because I like to know more about what's going on.
Yep.
The person doing it is certainly the day-to-day project manager.
Right.
But we talk a lot about what we're doing, and I'm heavily into managing the risk and organising the finance and the legals, and yeah, absolutely.
Well, it's
And
working.
keeping an eye on what's happening.
Yeah, so you kind of invest in capital in the deal, but also there to kind of coach and mentor at the same time with your experience.
Which is one of the main reasons. So, as you alluded to earlier, I'm lucky enough to already be financially free. I have been for quite a few years now. And I'm still doing things because I just enjoy them. And I'm trying to talk as much as I can about property investing to help other people get to the same point of financial freedom, but also do projects with JV partners to help them really get started and build their skills and knowledge and get going.
Let's touch on financial freedom again, because like you say, it's different for everybody, isn't it? And like you say, you're fortunate enough that you are now financially free. But when you are financially free and you've got nothing to do, it doesn't mean you just sit there with your feet up, does it? Because we still need to stay active.
Yep.
But financial freedom gives you options and
Choices
and time to sit and think about what you actually want to do. If you want to donate your time to a charity and support them that way, you can. Julie has set up Living Off Property and helps other investors create financial freedom using the structured portfolio approach, which is amazing. So really, it's not how much money do you need to live an extravagant lifestyle. It's how much do you need to cover your basic sort of living costs, rent, food, petrol. And then, like you said earlier, you can use the development side of things to buy the nice cars and all the bells and whistles that go with that stuff, if that's what you want. Yeah.
So that's not really me though. So what I've done is I've gone through and I know what my passive income, and I've got more goals for growing that passive income, but I don't intend the money that I use to support myself. I don't intend that to go up as such. It's just more, setting aside funds for working with other people. I've had goals for a while now of how can I just help educate the next generation. So as you know, I'm working with my son this year, so he's just finished uni, and it's like, how do I help him get started on this sort of project work as well? doing the same thing with nieces and nephews and friends of, friends of friends. And so I'm really trying to work with that next generation.
Yep.
I'm also trying to do a lot about how can we improve the missing middle in housing. So I want to put my time into the missing middle and really developing good, sustainable properties that support us as we're moving forward. And also we've been talking about doing HMOs, and I've been exploring for a long time because as a female that's been through divorce, I find I speak to so many women who are financially struggling in their 50s. And as you know, the demographic that's growing the greatest for homelessness is women in their 50s. There's so many of them couch surfing or living in caravans or living in their cars. And it's really, how do we help provide housing for that demographic? And it's one of the reasons we've been talking about HMOs. So you also asked me about other projects. We're doing a lot of work at the moment. I'm trying to look at, can I buy some of these larger homes in Perth that I could renovate, turn them into an HMO, but also land bank for the future. So in Perth, we have an R40 zoning. I'm looking for properties that are R40 or above that I can buy, renovate, hold them as an HMO for 10 to 20 years, and then the next generation can pick that up and choose what they want to do with it when the time's right.
Yep. And it's a good point you touch on there, because to buy that site with the R40 zoning, obviously the price is higher than something on an R20 block. However, it's got that development potential. So if you can generate a passive income, albeit smaller than what it would be to buy something specific for this, you're generating a passive income, you've got a block of land that's going up in value, it's got development potential for the future. Now that's surely got to be like the best way to land bank.
Yep. So I've never land banked previously.
You just develop.
So I will develop, and I've always held the properties, held some of or a selection of the properties that I've developed. And I deliberately make the decision which ones I'm going to hold, and I'll hold them for 5 to 10 years. And then at that point, I'll make a decision, is this a real long-term hold, or do I now sell it in this 5 to 10 year gap? And the reason it has to be sort of 5 to 10 years is that if you hold it, you don't pay GST on it after 5 years.
Something else you touched on there, Julie, the missing middle.
Yes.
Now we've classed the HMO as the missing middle of rental accommodation because you've got social housing in the private rental market, and it kind of fits nicely in the middle. But for the people that don't understand what the missing middle is in the normal property space, can you give us a bit of an explanation on that, please?
So one of the things in Australia, we're very good at building very large houses. I don't quite understand why you want such large houses.
The biggest houses in the world at 246 square metres on average.
It's absolutely ridiculous. So I don't understand, but we're very good at that. So I found when I returned, I'd been living in China when my marriage ended and I returned to Australia. So I had my 5-year-old son, and we're trying to find places to live. And you could get these large houses that might have a lounge room, a family room, and a games room, and 4 bedrooms. And I was like, well, there's just 2 of us. I didn't want to rattle around with it. So you've got that end of the spectrum really well covered here. And then all the push from governments at the moment seems to be around the high-rise. So they're building apartments. But I didn't want to take my 5-year-old into a high-rise apartment either. So what were the other? There weren't many other options. We actually ended up renting for a year, and I would have loved to have always done rent vesting, but we rented a duplex half. But it's very hard to buy a duplex half now. They're very difficult to come by. That's just not really around. But you go to other countries, like in the UK, they'll have a lot of terrace houses.
Yeah, heaps. I grew up in one.
Yeah, most people will live in a terrace house in the UK, but you can't. There isn't those sorts of options. Certainly in Perth, there are more of them in some other parts of Australia, but there's a big gap in the market for that. And given the number of single individuals living, a lot of individuals don't want to live in apartments, and they want other options. I mean, we're not giving people the options. No. So that's the missing middle.
And we call them the Mac mansions, the big houses at one end. So we've got 5 bedrooms, which they're the type of houses we as a company, as the HMO Property Co, love to buy. Yeah, absolutely. Because they're perfect for us to create them games rooms, theatre rooms, family rooms, all these other different names that they give them, and we convert them into bedrooms with ensuite, and it just works perfectly.
Which is what I'm trying to buy
for
for my reno to hold as an HMO.
So the missing middle of the property market is everything from small villas, like 3x2 villas,
Yep.
2x1 villas, for instance, all the way up to probably 3-story apartments.
Yeah, I'd call them boutique apartment blocks.
Apartment blocks, yeah. Which is another space that you've developed in as well.
Absolutely.
Yep.
Yep.
I'm just thinking, have we got enough time to talk about the development model?
Yeah, you want to talk about development partners?
Yeah, if you don't mind, because this is another really cool thing that I learned from you. And,
Okay.
Yeah. So, for context, for the people that are listening, Julie does developments, and she mentioned already that she invests her money into other people's developments, but she also does developments and gets other people's money into her developments. But it's a really cool way that she does it. So,
Yep. Okay. So I'll specifically talk about a site that I did here in Perth.
Yep.
And I've done them in Brisbane as well. But the one in Perth was solely on my own. So I bought the site, and I bought it in a bear trust, and I took that site and I got the DA on it to build 8 apartments. Mm-hmm. When I had the DA with the approved plans, I went to my network and I said, is anyone interested in buying and holding an apartment? And if you buy one of these apartments, and the prices vary, but let's say roughly the end value was worth, say, 500,000. So we're saying, this apartment we believe will be worth 500,000. You can have it by effectively buying it for 450,000. What you need to do is to put 200,000 into the construction phase of the project. So they would put 200,000 in for the construction phase, and they'd pay the 250,000 balance at the end of the project when they actually got the keys to the apartment. Mm-hmm. And I call them development partners. So in that deal in Mayland, so I built 8 apartments, I kept 2 of them, and I had 5 development partners, which also meant I'd raise basically $1 million of funding for my construction phase. Yeah. So that's how we did it. And because it was in Bear Trust, they had to pay, it was about $1,100 as stamp duty on their 1/8 of the value of the land when they purchased it from me when they joined the original project. And then they got the title at the end.
Brilliant.
And then what happens is, no one has sold it from that particular deal. So that was the first one that I did in 2014. We were still holding it. I pretty much do a lot of the, any maintenance work. A lot of it just comes back to me. We do have body corporate managers, so they do, but I'm on the committee and make sure things get done.
Cool. So some people might be sat there now scratching their head going, so the apartment was worth 500,000, but you sold it at 450,000.
Yep.
So here's the cool thing about it. When we talk about risk and the portfolio approach and managing risk, is the biggest risk in development is sales, selling the end product. Julie essentially sold all of these products before she even started and give them a $50,000 reduction, but didn't pay any interest on that money in the deal.
Correct. It's even better than that.
Yeah.
So they put 200,000 in, so they got 25% return on their capital. So my investors were delighted, and they always have been absolutely delighted. But it didn't actually cost me that much and they were told right from the beginning, you need to hold this property for 5 years. So my understanding of the tax and the accounting situation is, as long as they intend to hold it for 5 years, then they have no GST to pay. No one actually sold it with less than, no one sold anything in that one at all yet. Some of my other ones they have after the 5 years. But if they intend to hold it for 5 years and something catastrophic happened, like they lost their job and they sold it after a year, because they intended to hold it for 5 years, they wouldn't have had to pay GST. So I can't remember the exact numbers, but you save, 10,000-15,000, something like that on GST. Mm-hmm. Then you've got you're saving all your sales commissions. Yep. So maybe another 20,000.
Yep.
So there was and then I've got the interest saving benefit.
Yep.
So I was giving away a small portion of my profit.
Yeah.
So everyone was really happy.
Yeah. such a cool way to do it.
Yep.
Now, it's created a problem for you.
Yeah, it's fantastic. And my network love it.
Yeah.
But I've taken that, and we then started doing the same concept. We called them, so in that first example I've just discussed, I called them development partners. And then I linked up with another JV partner, and we started to do the same thing, and we called them downsizing partners.
Right.
So we did generally triplex sites, and we designed and constructed properties specifically for people who were downsizing. Perfect. And we called them downsizing partners.
Perfect. Same model. They put the capital in.
Yep. And can I mention the next one?
Yeah, absolutely. Go for it.
Well, now, you and I, we're working on some deals where we're trying to do HMOs of build to rent. And we're now talking about HMO partners. So we're trying to do the same thing, and we're working on pulling it all together at the moment, where people can invest some money and they will own some shares, if you like, or some units in a unit trust in doing this build to rent.
And the first time I heard it, I was the one sat there scratching my head thinking, but you're losing 50k times 8 apartments. But like when you explained it to me, I was like, it's absolutely genius. It's just de-risk the project. Absolutely incredible. Yep. Absolutely incredible.
Well, it works to everyone's benefit.
Yeah. But
except perhaps the government. On
the flip side of that, the problem you've got now is you've got all these investors that are knocking on your door constantly saying, Julie, we want more deals.
Yes, absolutely. But some of those investors are also, saying, Julie, can we just lend you some money for your next project as well? So some people want to just put capital into projects. I have even my project that we talked about that's going in Melbourne, one of the investors in my network lent me some money. I'm paying them 10%. I've given them a personal guarantee, and they are an ex-developer, but they're semi-retired now, and they're just saying, hey, come back to my portfolio approach. We want something that's a bit lower risk, and like me, they judge a personal guarantee for me as being quite low risk, and yet they're getting 10%, and they're doing it from their super funds. So they're going, this is fantastic. I'll lend you money. I'll pay them 10% at the end of my project. They've considered low risk. They've got a personal guarantee for me. They always get their money back. And they're as happy as anything. So I've got some people that then become development partners with me, but I've also got people that just invest cash with me as well for returns.
So there'll be a lot of people listening to this podcast now who need to use other people's money to do a deal.
Yep.
Can you give them 3 tips on how to find joint venture partners? I'll put you on the spot there, haven't I? Yeah,
no, it's okay. To me, the most important thing, I don't go out and sell things to people. I love to talk about property. So if someone is interested in property, I'll talk to them about property, and I'll try to understand what they're trying to achieve with property. They then try, especially when they realise that I've reached a point of financial freedom, they're often very interested in talking to me about how I've managed to do that. So I really try and share as much knowledge as I possibly can. So from just developing some sort of relationship from me, they are hopefully benefiting from that. So then what happens is, as I then might be explaining some of the current deals that I'm actually doing, they will then often ask me, oh, can I be involved in something like that? And I'll go, well, yes, of course you can. And then I'll explain it. So I don't actually go around selling. I just go around talking about property, trying to benefit the people that I'm talking to, and then people that I'm talking to will ask me. And that's probably the key thing that I do. The third thing that I'd say is the more experience you've got, the easier it is. But I would always have my own money in the deal.
Yeah.
So I think if you put your money in the deal, or you've got skin in the game, then it helps to build that trust relationship. So that was the third factor.
Love it. Thank you very much, Julie. I could literally talk to you all day about this stuff, because we have phone calls to each other like 90 minutes long.
Yeah. Normally when you're driving.
But I really appreciate coming on the podcast, Julie. I might get you back on again in the future. We'll talk about something different.
Okay, happy to.
Thank you very much. I'm going to leave you with this quote, guys. You cannot master what you do not measure.
Thanks for listening. Make sure you tune in the same time next week so you stay up to date with all the Cashflow positive property updates.